Can I share screens?
50p, mate.
You will do.
I got it ready.
Srinder's putting in the 50p's, right? Are we good to go, Srinder?
Should be now. Yep.
So you give us. Well, we won't. We'll stop mucking around. We'll stop. I don't know what we were doing earlier, but we were discussing 50p's, Simon, weren't we? Long time you've been skiving off. I think I'll make you stand in the naughty corner. All this skiving. We have missed you.
Thank you.
Well, yeah, but we're going to pretend we haven't really.
Yeah,
We are live now. We are live now.
All right, we're live. So no more swearing, folks. Yep, Thursday afternoon, 5 p.m. You know what that means? Time for the Property Professionals Thursday afternoon live show. Got a really great show, better than every other week we've done so far. Got got amazing two speakers today. So, Srinder, get your 50p's out, and let's get cracking. Special guest, but he'll be a surprise in a minute. So, let's get to the man with the money. I think he's been a busy chap. Akhil, welcome back. I think you made. What happened to you last week? You were stuck somewhere, weren't you?
Last week I was here, Dill, but I was at a networking event. Good to see them back in action. So I was at a networking event, but you know, I keep to my promise and make sure I do the mortgage market update on TPP.
Yeah, listen, don't worry. The tax guy's not here. We're not going to pretend it's tax deductible. You were out for a jolly, all right? Forget that bit, all right? Anyway, let's get on the show, all right? You can save that for the tax chap next week. He's skived off today, right? All right. So, yeah, that's all right. Of course, you were in an important business meeting where you had to have sustenance and refreshments for business and work purposes only, I think is the tax phrase that everybody uses. So let's get on with it. We're going to talk some money today, yeah?
Yeah, rather than doing a usual mortgage market update, we thought we'd put some questions out there, and I believe that you've got some questions for me.
Damn, I'll tell you what, I'm going to surprise everybody with a second guest, but it looks like I'm surrounded by money today, so get ready for everybody. Let's talk money with you, and we're going to talk some money with the second guest as well. I'm going to keep him as a surprise. Right. Yeah, he's laughing. Are you finding investors are changing their property investment styles? So what's going on with property investment styles?
Great question. I think COVID's certainly put a spanner in the works with regards to investment styles in terms of types of properties that people are investing in, whether it's, you know, from one-bedroom apartments to now they're looking at buying houses where they can add value to the properties, just simply for the reason of working from home. So rather than buying a two-bedroom apartment, they're looking at three-bedroom houses where they can then have their tenant working from home. The other benefit of people amending their investment strategies is to comply with a lot of the residential regulation, especially around the tax side with Section 24. So there is various changes that people have that people have had to implement and change with their investment strategies. But the key ones here to understand is the regulation around the residential properties in particular, and also geographically where people are investing as well. And I think that's one of your questions coming up. But what I would say is, in terms of investments, people are buying more and more houses rather than apartments, just simply for space standards. And also they're looking at properties in good commuter belt areas, as well as good prime affluent towns. So people are not chasing, well, I shouldn't say they're not, but most of the people are chasing yield as well as capital growth. I know it's very difficult to get both in one go, but a lot of seasoned entrepreneurs are still investing in the Southeast just for the same very reason that that's where they think that the capital growth will be seen in the very near future, as well as just chasing yield for properties further up north.
I'm going to come to that in a minute. So next question for you, and you're the man with the money, and we talk about this. Inflation, what's it doing? And how is it changing things?
It's certainly changing things. It's every media outlet is talking about inflation now, and what number is it going to reach to? Now, there's a lot of data coming out recently. We're now at 5.5%, which is, nearly 3 times the target for the Bank of England, for the UK government, which is 2%. So we're well above the inflation target of 2%. How do we combat that? Who knows? I don't think interest rates is going to combat reducing the interest rates. I think there are further ways of reducing that debt, that inflation pressure. And one of the biggest things are in ensuring that we can combat things such as supply and demand. Supply and demand is obviously a big factor in inflation. The cost of materials has inflated inflation for that reason as well. Combat that, and the easing also of COVID restrictions globally has meant people are spending more and more money now as well. So that's pushing up inflation. And also there's a war going on, a potential war going on in the background with Russia and Ukraine. So this is another factor at the moment that's playing a big factor in inflation prices. What I would say is, we're at 5.5 now. I think that the honest opinion is, who really knows what the real inflation price is? I actually think it's nearing 8%, to be honest with you. I think, to be honest with you, I'm more of a positive thinker. And I think the inflation target, inflation will certainly go up. I think it will come down crashing for the benefit of us all in the next couple of years. But I think we've got to bear it in mind, and we've got to hedge our bets and invest strategically, especially in the next couple of years.
Carla, are you free this weekend?
No, Joe, he's not. He's busy. Sorry.
Yeah, I was just wondering,
Go on, Joe.
Yeah, no, I'm just. No, never mind.
All right, don't worry. You can come back later on. So it's a pleasure. No, Akhil, you're not free this weekend. You're priceless. Right. Okay. So great question. Great speech, Akhil. I can't wait for you to get into number 11 and then 10. You're obviously practicing for it, especially the bit about the war and so on. Right. So what are your predictions for 2022, 23? And where do you think inflation is going to peak at? Let me add that in.
I think inflation will peak at about 8%, to be honest with you, for those very reasons. I don't think anything's going to calm down with regards to COVID, supply and demand, and energy prices in particular. So, those things are a global issue, and, they can't combat them overnight. So I think the next 12 to 18 months, we'll see inflation pressures, and I think they will certainly reach the target of about 8%. With regards to interest rates here in England, particularly, I should say, we've seen 2 short rate increases. They've gone to 0.5%. In the grand scheme of things, that small increment in change is not really going to become a detrimental effect on all mortgages. But what happens is when they happen often, and what I mean by often is every month or every other month, that then becomes a detriment on household expenses. When you've got energy prices going up, cost of food and drink going up, it does certainly play a factor. And for those of you viewers, I should say, that are on standard variable rate mortgages, on tracker rate mortgages, you've got to be conscious that, a month later, those mortgage rates, your mortgage payments are going to go up. So I think 2022 is going to see a sharp increase in interest rates. I think the Bank of England are going to be pushing them up going forward. On my target, or my opinion and my prediction is we're going to see a rate increase up to about 1.5% by Christmas of this year. For those very reasons, with regards to inflation pressures, supply and demand, as well as COVID restrictions and the war in Russia with Russia and Ukraine. You've also got to keep a strong eye on the US market as well. The 10-year Treasury note as well, it's gone up. It keeps going up over the last 12 months. We're now above 2%. So that certainly means an increase in interest rates in the US. As I've always said over many years, when the US, if there's a little sniffle in the US market, the world will catch a flu.
But are you free this weekend or not?
So what I would say there is you've got to be mindful of rate increases. It's paramount. It's going to happen. So what do? You've got to make sure that you review your portfolios now rather than later, and then you also have a good power team around you to understand economic fundamentals as well as the mortgage market as well. So that's my short answer and opinion on the market for this year.
Yeah, no, great. So you're predicting the war. You reckon interest rates are going to go up to 2% then?
I don't think 2. I think about 1.5 by this year. What's key here is, I keep going back to it, is around COVID, the Ukraine, Russia issues, and the supply and demand. The sooner they can combat that.
Simon, you look kind of bad though.
The sooner interest rates, can we mute Joe, please? Thank you. The sooner we can, won't see any rate increase. Got to bear in mind, the other thing you have to bear in mind here is the UK government really can't afford to increase interest rates sharply because they've got a major debt on their hands. So if they increase their rates, that means their interest payments have to go up as well. So, you know, who would really want to be the Chancellor or the Bank of England Monetary Committee in this day and age? You know, to be honest with you, I won't. I do live in number 11, but I don't work at number 11. So that's what I would say there.
Because you work from home. But as my old economics professor, Mr. Thomas, said, interest rates act as a signaling device as well. So, you know, the fact that, and it's interesting what you said, they're putting them up 0.5% month after month, or they wait a month and put it up another 0.5%. They're saying, guys, stop spending your money, save your 50p's because the interest rates are going up. Basically, that's what they're trying to say in the background. Coming back to your geographical point, what's this geographical strategy? And it's interesting you said that they're looking at the southeast commuter belt. So suddenly with Zoom and people saying, I only need to go into the office once or twice a week. I can live further out, handle more hassle, but have a bigger garden for my barbecues.
Yeah.
As we're doing one next week at a restaurant, apparently, anyway. Or some of you guys are. So geographically, where are we going? Where are the investors going with that?
There is no certain town that people are all flooding to. What I would say here is it depends where you are in your journey in terms of your investing journey. Now, if you're setting out in property, you usually want to borrow at the highest loan to value ratio where possible. So for those reasons, people are borrowing at the high levels because they're trying to chase yield, they're trying to chase passive income and chase, you know, regular income. For that reason, people have to venture further up north, and that's north of Birmingham, just simply because the yields are, you know, 5, 6, 7, 8%. Whereas London and the southeast, you know, yields are still 2 to 4%, which is extremely, you might look at it as low or on balance, on par with where the market is at the moment. But if you're borrowing in a limited company capacity and your interest rate is 3%, and you're investing in London and your yield is only 3%, you're balancing the book. So whereas you're not really making any money through the rental income, however, the capital appreciation you will find that will go up substantially in the southeast and in London in particular in the short to medium term. Whereas in the smaller towns further up north, you know, you might benefit from good cash flow and good yield, but you may not benefit from the capital appreciation because that will come in the foreseeable future. So it depends. In the short answer is it depends where you are in your journey. It depends on your time that you've got and energy that you've got to put into deals. Now, if you live in London and you want to invest in Hartlepool or Manchester or Blackpool and the alike, you've got to be conscious of time, energy, and the costs of you managing that property further up north. So I don't say there's any right or wrong investing anywhere in the UK. If you look at house prices, the average house price in the UK, it keeps going up one way. So, you know, you certainly can't go wrong, but it depends where you are in your investment journey. What I would say is our seasoned investors are now moving into more complex buy-to-let properties, and in particular, the multi-unit freehold blocks, the larger HMOs being it 7-bed or more, and also the super seasoned investors who have got a bit more cash to play with are now moving into semi-commercial and commercial property, just simply because they see the added benefit through permitted development and the relax of the restrictions from that side. So it depends on where you are in your journey. It depends how deep your pockets are and how time conscious and experienced you are. You'll then venture into those certain areas in terms of in the UK, as well as that type of property.
Yeah, we're going to come to deep pockets in a minute. And you were talking about this 2 something and 3% returns, and commercials have higher returns, don't they? Or there used to be the property investors before the residentials took off in the 80s, as somebody said to me. What are commercial conversions options and refinancing for that sort of project? Have you got any thoughts on that?
Well, the key here is that you've got to remember the cost per square foot is a lot cheaper commercial than it is residential. However, commercial is going through a transition at the moment where there's a lot of retail commercial units that are vacant, that are not fit for purpose going forward. So you have to then bear in mind what can you do with that property, whether you can convert, because the real money maker in commercial property is converting commercial into residential. You know, that is fundamentally where you're going to add value and make the cream on every deal. So if you manage to buy a retail unit, convert the back, convert the uppers, and so on into residential, that's where you're really going to eat and make them earn the profit from the conversion. Your question around, you know, how to refinance that's very simple. You know, you don't want to think about refinancing a conversion after you've done it. You must think about the refinance on day one in terms of acquisition of the property, to make sure that you've got all the ducks lined up in order for you to do what you need to do to get the best out of it, to then recoup all your cash ideally, and if not a bit more, to then refinance and get out and go again shopping. So the key here is to work with your power team at the time of acquisition, work with your mortgage broker to understand where the market lies in terms of the refinance of commercial properties, in particular the semi-commercial or pure commercial, because the commercial market is a very, very liquid market at the moment. Lenders are changing their goalposts, in particular what type of trade, whether they're like trading businesses or whether they're like investment businesses. So you've just got to be conscious of what lenders you're going to be approaching, what the rates of interest are going to look like, and ultimately how much you're going to be able to pull out from the refinance of the deal. So, you know, there was a great article out today by Savills around commercial property and their analysis on that. You know, they're big believers that retail property are going to benefit first, and shopping outlets are going to benefit most out of this coming out of COVID going forward in commercial property. So I certainly believe that I think that, you know, if you're looking for commercial property, try to look for an affluent town with a certain good demographic, good foot flow, and good commuter belt traffic locally as well.
And Akhil, I wish you'd told the viewers to put down their colouring pencils and get out their writing pens, because that's a magic piece of information. Surinder, if we can link out to the other videos we've done. So Akhil, you said something very interesting. Get your mortgage broker for commercial conversions on day one. You'll have to go through we've done interviews with the solicitors, Remo, who said the commercial evictions are on suspension at the moment. And we've also, in a bank of videos and interviews, you'll also see Linda Wright, the headmistress, doing a little amazing talk on permitted development available. One last question. I want to get my money's worth out of you, mate. We're putting our 50p's in. Where do you see the lending market heading in 2020?
2022. So the lending market, I still think is very, very much buoyant. 2020, I feel like an age.
I'm still in 2020. Yeah.
What I would certainly say is the lending market is extremely competitive. Rates are still very much on their knees. Lenders are willing to lend, and we've got great criteria, great loan to values, and great products out there that lenders are offering to lend. What I would say, I'm a certain believer of real estate in the UK in particular. It's a great safe haven, and it's where the most of the entrepreneurs in the UK have made their wealth, and it's all through property. I think the key here is to understand the type of investment you're getting into, and before you get into it, understand what you're going to be doing with that investment property and where the value add is, and then looking at refinancing it at the uplift value. So I certainly think it's a very competitive market. I still think there's money to be made in buy-to-let in particular, albeit here in the London and the Southeast where we're sitting. I don't think we're going to see double-digit growth as we did in 2021, where it was 10%, 11%, depending on which index you look at. I think we'll be at 6 or 7% increase in property prices, but what that does mean is the market is still very much buoyant, and that then shows confidence in the market. And you can see that through all the analysis, through the market commentary that we're having at the moment. So it's all about your individual goals. I still think, you've got to look at your individual cases and work. And I keep going back to it, is work with the power team. You can never know it all. It's, the market that we're in is always changing. So, educate yourself, join the channels that you put on every Thursday at 5 o'clock, because there's always something to learn. But what I would say is, I think it's a great market to be in. There's plentiful of lenders out there in the market. Rates are still very much low, whether you're borrowing in your personal name or a limited company capacity. and you can borrow up to 95% if you're borrowing it for your main home purchase, or even up to 85% for a buy-to-let. So, why would you not? Back in the day, Jill, you probably remember in the 80s, interest rates were probably what, 13, 14%? And now they're at 1, 2, and 3%. Would you bite my hand off today?
No comment. I don't want to give away my age, but you're not wrong there. So,
well, we were paying 25% at the time to borrow money.
Wow.
We don't want to know where you got your 50p's from, Srinder. Akhil, so that ends the running speech for Akhil, the future mayor. Hi, Simon.
Still, Akhil, just a quick question there on the back of what you were saying. Is the rumours true about people not investing so much in buy-to-lets? Are you seeing any change there?
To be honest with you, I haven't seen it, because since the last couple of years, our phones have never stopped ringing, and nor have the inquiry levels. I honestly, hand on heart, we are so busy at the moment. We just don't know what to do with the business, but our business and our team has been growing throughout the last couple of years. So on hand on heart, no, certainly not. I'm talking more they're saying the more matured buy-to-let investors are disposing it. You might be getting new people buying them, but is that true or not? If you look at the estate agency, if you look at Rightmove, the number of properties coming onto the market has slowed down. So that, I would say that actually shows that people are not selling off their properties. What they are doing is refinancing their properties. And I think that will be the trend for 2022, is the refinance of the market, because a lot of the PRA changes came in 2016, 2017. So they went into 5-year fixes. So we'll see a lot of remortgage market rather than a lot of selling market. So I think this year in particular, over the next 12 months, is more about remortgaging and redeploying that cash into further real estate. But the problem here is there's not enough properties out there on the market. But honestly, the answer to your question, we haven't had any of that coming on, and people saying that we're selling off our book and we're moving to Barbados or whatever it be. But no, far from it, to be honest with you, Simon.
Fair enough. Thank you.
Right. So that ends the Prime Minister's next Prime Minister's speech after he becomes the Chancellor for Akhil Mir. Breaking news on TPP. But anyway, look, Simon, you jumped the gun, but we had to let you off. Look, put down your colouring pencils. Actually, I missed that. I should have said that on the last speaker. Get out your writing pens. We've got a fantastic guest. Friend of the programme, Simon's back. He's been skiving for a while, but we'll let him off. Before we let Simon on, and he's another man with more money, and he's going to talk about more money. We're going to have a little commercial break from Srinder, who's going to tell us about a picnic we're arranging next week. Srinder?
Right, yes, we have a meeting of our TPP, the first one since the pandemic, and it's going to be a social gathering rather than a speaker-led meeting. So we'd like to invite everybody to come along. It's on 24th of February, Thursday, starting at 6 p.m. at the Laguna restaurant. All the details are posted on Facebook and everywhere else on our pages.
That's probably Laguna saying we're running out of numbers. So yeah, book yours fast. Contact Srinder on Facebook. Laguna in Ealing, lovely restaurant.
And full meals or 4-course meals, so come and enjoy yourselves.
Yeah, and you might broadcast it as well. So next week, no speakers event, but you might have a restaurant. It might turn into a restaurant event.
That's right.
So anyway,
we're working on it.
You're working on it. So you're going to take your 50p's to the Laguna in Ealing. Right. All right. So that's enough of that. No, enough jollity. Right. Simon, back to the question in hand. Money. Simon, great friend of ours, knows what he's talking about. Worked in the banking industry for 25 to 27 years. Don't boo that. He really does know. He's one of the good guys. We only have good people on here, right? Simon, I'm going to stop faffing about. I've got my writing pen out. Srinder's going to put the 50p's on, and you can share slides. So off you go, sir.
Okay. Well, thank you for having me back on the show. It's a shame I can't make your social next Thursday because I'm away.
Hang on, Simon. It's not a social. It's a working meeting for tax deductible purposes.
Okay.
Don't tell Arif that, for God's sake.
Okay. Well, whichever way you look at it, I think it will be. It's lovely to get back to face-to-face meetings after so many Zooms. So I hope that goes well, and I look forward to coming to the next one when you get cracking with that. I've got to let's get the. So why I am here today. I've been invited by Dill and Swinder to talk to you guys about SAS and SIP pensions, and really about how you can use your pensions to invest in property instead of staying in the stock market. There's a pension wrapper out there. People are not familiar with it. It's becoming more and more with people in the know, people coming to property events, they're watching other people and thinking, wow, I've got a pension fund. I could do that with my pension fund. And Dill was joking about I'm the man with the money, but really you're the man or the woman or the person with the money in your pension. You might not know how to use that to invest with inside a property journey. So this chat today is about a existing pension fund, how you could use that money to invest it on a property journey, and how these wrappers differ to a traditional pension. So let's just go through that. So just a little bit about me so we know what's going on today. Dill already alluded to it. I was a regulated financial advisor and an accredited mortgage broker. I stopped practicing in 2013 and now run a financial consultancy basis because we do a lot more than just the wealth and arranging mortgages for our clients. We got involved in property and many other things. So I know all about pensions, I know the rules, but I'm not advising today. And whenever you make these decisions with your pension funds, you have to, well, you don't have to, but our recommendation is you should always seek financial advice. I'm only going to say that the once in this meeting, because it's so important. Every financial decision, that's what you pay these people the money for, to actually get financial advice, and that's key to these conversations. But anyway, so what we would look at, so if you had a pension fund already in existence, let's just put some numbers on it, and we see lots of people with 100,000, £500,000 in a pension fund these days. Ones who've worked all their life, build up these significant pension funds. There's people out there with millions in pension funds now. And what do you do with it? That's a real interesting question. What are you doing with your pension fund? Now, sadly, people don't have that much interest in their pension funds. And if you ask a lot of people, they're like, well, yeah, it's kind of invested in the stock market. The advisor does it all for me, and I just get the statement once a year, and I'm not really sure what's going on. It is worth about this much money, and people don't give it the respect really it deserves. And it just gets around to retirement, and oh wow, it's done really well. So this is about a conversation about, if you're happy with that, then you carry on with that. But if you wanted to use that money to invest into property, let's just have a look at what's gone on over the last 20 years with the stock market. So if you just take the FTSE 100 index, which is the top 100 companies in the UK, and you looked at that, it would show you that the market industry was around 7,000 points. And yesterday it finished at 7,500 points. So there's not really a lot of growth there. If you went in at that high period of time and you're still in there and you haven't done anything else in the meantime, yeah, you would have got some dividends from your funds. It would have grown a bit. It would have done well for you in terms of giving you a little bit of a return, but could you have done better? And that is what this conversation is about. Or do you want to take control of your own pension funds? Are you ready to make that journey? Because if you are, then Akhil just talked about this actually, really, about the sheer demand for property, whether it's through investment, whether it's to actually live in it, has driven up the price of properties to double in the same period of time. So that is a capital increase, straightforward, no ups and downs really with this market in terms of, yeah, I can't really say no ups and downs, of course there is, but that over those 20 years, you've doubled your money in property. If you're looking on growth, I put it down at 75, but you could look at it 100%. It really just depends on how you want to like actually say the returns, but the numbers speak for themselves. So that's why I showed that. So, okay, so let's just rewind a little bit. So if you have funds in a pension fund, it's with an IFA at the moment, and you're thinking, do you know what, actually, if I could use that on a property journey that I'm presently on, would that be good for me? Do I want to make that change? Do I want to actually take responsibility for my money? And that is what a SAS wrapper will do. It stands for a small self-administered scheme. You need to be a director of a limited company. And if you are, you can set these up. You set up your own pension scheme with the SAS trustee, the pension comes across, and then you follow the same pension rules. You have the same contribution levels, you have the same exit routes. Nothing changes in regards to those sides. But what does change is what you can do with the money by having a SAS or a SIP wrapper around your pension fund rather than just a personal pension. So if we look at a straightforward option, which is a SIP, which stands for a self-invested personal pension. Now, a lot of pensions these days are called SIPs, but they're not really SIPs because they don't actually do what it says on the tin, which you could use your pension fund to actually buy a commercial property. Now, you cannot buy residential property with any pension funds. You can't do it, full stop. Just wouldn't be authorised in terms of as a purchase, and the SAS trustee won't let the funds go either. But if you did do that, so if you had 250,000 in a fund and the shop comes up that you wanted to buy, that's a commercial property, you could buy that with this. Then what you do with the shop after that, that's up to you, how you get a return from it, what you're going to do, whether you're going to do some sort of property venture with it. But what I'm showing you is a way of taking your pension funds and starting your property journey with it. And that's the real, you don't need to ask a bank for the money. You don't need to ask anybody else. There's no equity side. You're just using your pension fund. That pension fund owes that property. All the rental coming in goes back in the pension. It's very straightforward, very simple, but that's the way to do it. There is also the opportunity to approach a bank and ask for a 50% loan of the value of that shop. So you could buy something bigger for 375. Obviously, you've got to keep the mortgage payments going and the rent coming in, the costs, all of that. It's all going to go through the pension, but it's still real. It's a real debt and it's a real fund. So that's something you can consider. On the bottom of it, of this slide there, which I make these slides available, is a really good blurb by the Prudential. So it's one of their 4-page PDFs around buying a commercial property using your pension funds. And so I've cut and pasted that into this and quite happily suggest you have a read through that if that's of interest to you. But if you buy a SIP, the only thing you can do with it is that. If you're a director of a limited company, and if you want to do something more with your pension funds, then there is another less familiar term called a SAS, which is very rarely used, and it fits in very well on the property journey, and why we talk about this a lot with property investors is one of the main reasons property developers fail is just down to lack of money or given the opportunity when maybe they didn't realize they had the money all the time in their pension fund that could help them. So with the SAS pension, once you become a director of a limited company, you can have one of these. There's no other conditions to that. It just needs to be a trading company. And then it gives you different options to then use your funds. So there are a couple of things. I'm going to go into the detail with it. You can still buy commercial property with the SAS, but you can also arrange loans to other limited companies, or you can even arrange a loan back to yourself and your own company. I'm going to go through some of the criteria of that with some of the viewers to see if it's of interest. Whether you do a SAS or a SIP, remember, you can't invest in residential property directly yourself. So let's have a look at how this would work. So we've already covered this off because the SAS can do what a SIP can in terms of own it. So in this equation, I've just put in there that if there was 500,000 in the scheme, you could quite easily just go and buy an office, range of shops for 475,000, hold it, and same thing. You can borrow money on it, exactly what we just talked about with the SIP. If another option is you might not be able to spend all the money in the pension fund on your own property journey. You might have some left over and you might not be happy with the returns from the stock market. And that's why you want to look at this type of journey. You're interested to invest in property. So what you can do, and if you look at the title of this, it quite clearly says it's a third-party loan, and it must be an unconnected loan to a business. So not a member of your family and no one you're in business with. And these are key criteria that are strictly monitored by HMRC and SAS trustee. You don't want to mess up there, because if you do, you make an illegal loan, you'll get a fine by HMRC of 55% of what you've lent. So it's a big bill if you lend someone £100,000. But in the previous example, if you had 500,000 in the fund, you've only got 400 available to spend on this property, because that's all you want to spend. You left 100 behind. This gives you an option to arrange a £100,000 loan to another, in this equation, property developer. It doesn't have to be property, but that's why it works so well, because property developers want money. And they can usually offer you some form of security, like a first or second legal charge. So you actually start to act like a bank. So you're looking at a deal, you're looking at a proposition, someone's coming to you and say, lend me 100,000, I've got this property development on the go, I haven't got enough money to complete on it, will you join in on the equation, lend the money to me, we'll give you a fixed return, or even a return on the equity in the deal. It's up to you to set all the terms and conditions, from the security to the return that you're going to get. It is not like something that's set in stone around the loan. It is quite easy to arrange. You just literally engage with lawyers, and the lawyers speak to the SAS trustee, they speak to the property developers' lawyers, the loans all go through that side, and that's how the deals are done. So that's a way of maximizing it. Alternatively, if you didn't want to put this a loan to work as a as a venture, you can still invest in the stock market using your SaaS pension wrapper. Obviously, it's not the best idea to do a SaaS and just invest in the market. There's no need to do that, stock market, but this provides a good source of fixed return on your money. So there's no ups and downs like with the stock market. If you lend the money, 10% return, you know at the end of the 12 months, £100,000, the interest return is 10%. Obviously, you've got to get the capital and the interest out of the developer. You've got to make sure that deal works. But that, in a nutshell, is why these types of loans become popular. So now this one, last part, is very key, and why lots of SaaS people exist in the property world. So what you're able to do is, if you had, and it works better obviously with larger sums in your pension fund, but if you had 500,000 in your pension fund, you can arrange a loan back to your own limited company of 50% of the value. So that's £250,000 you are lending back from your SaaS back to the limited company. Now, whatever your limited company does, so if you're a property development company and that's your SIC code, then that is what the business funds need to be used for. If your business makes cakes, then you have to use the funds for that. You can't just set the take the loan out and do whatever you like with it. It's got to match. There is one key difference in these types of loans to the other one. So this is where you need to pay attention to the detail, because with this type of loan, you're lending the money back to yourself. So the SaaS trustee and HMRC are rather keen that that money comes back to the pension, and to focus your attention, they will insist that you provide a first legal charge as security or a debenture of the value of the loan that you've taken against it. So you can't do it unless you can provide that type of security. It doesn't have to be yours. Obviously, you need consent and legal advice, but you could actually, for example, use your parents or something like that as a property first legal charge, as long as they consent to it and they've had legal advice and understand what's going on. Because that's a brave move, but just so you're aware, that is the option. The loan is repayable over 5 years, and 20% of the capital is repaid each year. So what that means is, if you borrow £250,000, you have to repay £50,000 each year without fail, or the loan goes into default. So where that could work really well, we've seen it work really well, is when people do refurbishments or deals with permitted development rather than planning needed. So they get them done within 9 months. So they're not actually repaying the capital, because the loan gets repaid before the first capital repayment's needed. So you're using your own pension money to fund your property ventures. And with some of the deals out there, that's achievable. Can you do better than the stock market? That's really what you've got to be looking at as to whether this is the best use of your money. Lastly, on that one, you set the interest rate because it's your loan, your pension fund. So people say, well, I set it really low, but if you can afford it, it is a tax deductible business expense, but it's got to be at least 1% over base rate as a guideline. So even today, that's still very, very cheap money if you take it all the way down to that level, and you're providing yourself with 250 grand to then invest into your own property journey, and what you want to get involved in. So with the SaaS and the SIPs, it's not right for everybody. I'll be clear on that. but it's quite interesting when we go to these property events and I talk to people, I make speeches, people are not aware they can do this. So we're out there, there's 10 of us that meet up, talk about what we can do with the SaaS and try and find deals, lend it to developers. That's what we do. So some of us get involved in our own journeys. Other people just sit in the armchair, don't do anything, and just invest the money with the developer because that's all you need to do. But it really is that simple to get it done. It is a bit of a laborious task to actually set it up, and we can help there in terms of helping you on that journey. But SaaS is all about you taking responsibility of your pension funds, and I always say that to people at the start. So it's a bit of a form-filling exercise that you've got to go through. So that's really it. The delays at the moment is just about HMRC approval for your SaaS scheme, and that's anything from 3 to 4 months at the moment. So it's not a quick process anyway to get it set up. It's not fraud or anything like that you might see on the internet. The fraud comes in the other end when you start lending the money out, and that's where you need to be careful around the deals that you're lending and what you're doing, because you are taking responsibility for your money. So my details are on the bottom here. Happy to take questions today, or you can just email me, contact me on these numbers, and yeah, just go from there. Happy to provide the slides to Surinder if anyone wants to see them at a later date, or maybe just watch it back on YouTube. I think might be another option anyway, or the social media channels that we're going out live on presently. But I hope I've covered it well enough for you guys to understand today. It's not always the easiest topic when you talk about pensions with people, but it's straightforward when you weigh it up in your head, as in what do you want to do with your pension funds? Do you want to leave it in the stock market, or do you want to invest it in your property journey? That's really the question you ask. And if it's the second and you're a director of a limited company, you should be looking at a SaaS. That's my suggestion.
Simon, thank you very much. I had a bit of an emergency there. I think I run out of 50p's, but Surinder so kindly put some more in. But it is an interesting presentation, because one of the major resources in property is money. And although it sounded like a joke, I wasn't joking. We've got the money men here today. Couple of questions for you, Simon. So you took very good presentation, very well delivered, and I'll forgive you for the lack of jokes because it was really great content in there. But we can start that up in a minute. When you talk about people having 500,000, 500,000 to $1 million in their pot, people might not understand that because they've only got a £15,000 a year pension coming in. Say someone had a £12,000 to £15,000 pension, what could that possibly equate to in terms of what they've got available?
Well, it really just depends on what they've done with their journey. There are looking at the panel, all of mixed ages, but somewhere on the lines, when we worked in the 80s, 90s, 2000s, then people were, if you were employed, people had pension funds, and half the time they don't even realize it. I'm 53, and out of a collection of my school friends, we've all got pension funds because we've all worked all our life. I was the first to go self-employed 8 years ago, but I mean, before that, I worked for 28 years with a bank. And this is the key to it. People you talk to, they say, yeah, I've got a pension fund actually. And you're like, well, yeah, but I can't touch that till I'm 55. This is the chance to change it, because you can change it now. You don't have to be 55. If you haven't built up a retirement fund, what have you done for your retirement would be a question an advisor would be asking you. Maybe you've set up buy-to-let investment properties. Maybe you've done something else. Maybe you're relying on inheritance. You know, it's all a collection, but SAS pensions applies to people with pension funds. If your money's not in a pension fund already, then you have to question whether it's the best tax advice to put more money into a pension fund and create it, or just take the money away from the bank and invest it in the property journey in the first place. Because if you put it into a pension, you're going to have a lot of restrictions attached to your money. Yes, you've got all the tax advantages to it, but you've got the restrictions that go with it. If you're actually like taking a pension out, it depends on how it's done. If it's one of these final salary ones and you're taking it out, it's too late. You can't do this type of scheme. If it's one that you're just drawing money out, you've got a fund there. If you've got 300,000 in a fund and you're taking out, say, 3% each year, which is your 15,000 a year pension that we're talking about, well, it's a bit more than that, it's 5%. But that's really how it works still. It really is a question of looking at your own circumstances. SAS pensions is not for everybody, as I said. There's a very small amount of SAS pensions out there, and if people knew about it, there'd be an awful lot more of people doing it. But because they don't know, they're scared to take control of their own money, and it's not right for everybody. I would stress that, but it's worth having a discussion to see, can I use it? Can I do this with my pension funds? This is what I want to do.
Yeah, don't be scared. We've got Super Simon here, Simon Sherlock. Surinder, have you got a question for Simon?
Yes, of course I have. Simon, say somebody does have a pension fund,
yeah,
and they want to get, how easy is it to get set up a SAS pension?
Right. Well, to get it set up takes about the actual process of setting it up is quite time consuming, because you just approach the SAS trustee, you fill out a few application forms, it takes about 2 weeks, but there is a magic HMRC tax approval that goes to your scheme. And unfortunately, due to COVID, HMRC only had one person in the SAS department approval room. So they have a huge backlog. Now, I was talking with a SAS trustee in November last year, and the delays was creeping up towards 6 months to get an approval. And I think they've employed someone else, bless them, in the HMRC desk, because suddenly you got 5 through at once. So the timescale is coming down all the time. Since I've been involved every day in SAS for about the last 3 years, I've watched the timescales start about 4 months, go down to 6 weeks, and then go back up to 6 months. So the actual process of getting it set up is about 2 weeks. It's not something you can do online. You're going to fill out forms. They're going to vet you. They're going to check what you're doing, your story, what you're going to do with the pension funds. That's pretty easy and done within 2 weeks. It's the HMRC approval that's the unknown. And that, I would say, realistically, I'm afraid it's about 3 to 4 months to wait for one tax code to come back from HMRC, but let's hope it improves again and they employ another person.
Okay, there's a question just come in from a viewer, which says, To clarify, to set up a SAS, we don't need to be of pension drawing age, do we?
What age do they
one
start?
to grow a pension.
Well, that's what we were talking about with Dill. I mean, you can set up a SAS scheme with no pension at all, just as your pension fund. What I would say to you is you're going to pay roughly about a £2,000 fee to create that fund. So during that first year, how are you going to make money from the pension fund? Because if you put £40,000 in there, because that's your annual limit, then if that's all you've managed to put in there, what are you going to do with the 40,000 on the property journey? So
in that case, they might have to wait 1 or 2, 3, 4 years before they can build up that
it might be
fund.
the case. It's a question of sitting with people, and that's where financial advice comes into it, because you can backdate pension contributions. If you've got money in your limited company, you've done really well, and you're looking to backdate some pension payments and build a substantial fund. These are all conversations, but I would say realistically, to get any value from having a SAS pension fund, you've got to be looking realistically of having a fund value of at least 50,000, because what are you going to do with a figure less than that in the property world? Because who are you going to lend smaller sums to?
Sure. Okay. The same viewer has now said he has 260k in his pension. What can he transfer? I believe your answer was about 50% they can use.
So is that in the chat question?
Yes, it is in the chat question.
Yeah. So absolutely. That would be, I mean, 260,000 is a great start within a SAS pension fund. You could do a lot of things with that in terms of in the property world, and setting that up. That is minimal sums. I mean, if you're invested, viewer, in the stock market, you're paying somewhere in the region of 1% annual management charges to the funds, maybe even higher. So you're already paying £2,600 in annual management fees for someone to invest your money. So when you have a creation fee, somewhere between £1,500, £2,000, depending on which trustee you go to, you're instantly winning, as long as you've got a journey for the 260. So when it goes into the SAS, it's created and set up. You've got a journey. Think, yeah, I know what I'm doing with this money. This is what I want to do. Let's get it set up, and then I'll crack on with my investment journey.
Simon, that's a lot of 50p's though, isn't it? £260,000.
It is. And these people, do you need financial advice? Then the answer to the question, as long as it's not a final salary scheme, is it's not compulsory, it's highly recommended. The SAS provider, the SAS trustee, is going to say to you, have you had financial advice? And he's going to say, no, they'll still do it for you, but they want to know if you've had financial advice.
Okay, now coming back to this mysterious trustee, and the other question was, my question was going to be, how much does it cost? That you've answered. The trustee, how do you find and work with this trustee, and what financial advice you need before you go to the trustee?
So with the trustees, there's a collection of them out there. It comes back to the original conversation about SAS pensions, SAS funds that you hold. It's about you taking responsibility of your money. The trustee is there to guide you through the rules. So when you go to the trustee and say, can I do this? The trustee is going to make sure that you don't fall foul of HMRC guidelines around what you can do with that money.
And what are his fees?
Well, the annual fee for running the fund is about £1,000.
And that includes the cost of the trustee, does it?
Yep.
Well,
Simon,
that's not too bad.
Is that fee fixed regardless of the amount that's in there?
Yes.
Yeah. Okay.
So it doesn't matter whether you've got 500,000 or 100,000, still the same number. Depends on what you do with it. If you do lots of loans and things like that, there might be a few extra fees, like 250 quid for his time to process those fees on your behalf. But just to have the fund there running each year, if you've already done the loans and don't do anything, the annual fee plus, which includes a tax return done by them to the pensions regulator and HMRC on your behalf. It's about £1,000 between them. Some charge a bit more, some a bit less. So there's a collection out there of people to choose from. One of the ones that a lot of people go to is Whitehall because it's very cheap compared to the competitors. Whether or not that's the best one for you, it depends on what service levels you're after. So,
okay, just to clarify, you said first question he's going to ask you is, did you get financial advice?
Yes.
Now, what type of financial advice is he sort of talking about?
So the financial advice is around your pension fund. So what they're actually asking you is, have you considered the loss aspect of taking your pension away for you to manage yourself, invest in, say, a property journey and losing the lot? A financial advisor would sit with you who's qualified within pension transfers as well. You need to find a specialist pension transfer financial advisor to actually determine whether or not you are capable to invest your own money. And some people don't need that advice. They're quite familiar with what they're doing. They understand property. They don't understand the stock market. So that is what the advisor is going to do. He's going to sit with you and say, right, okay, if you take this money, you go off, you put it in the SAS, you lose it. How's that going to affect your financial lifestyle for your retirement? If you do really well for it, it's an irrelevant discussion, but that's what you're paying the advice for. And also they assess your risk appetite to see whether or not you have the right risk mandate to be doing this type of investment journey.
Right. So if somebody wanted more advice, more clarification things, are you able to, as you said, you don't advise people, but will you talk to somebody?
With SAS pensions, then it's about you taking control of your pensions. So we don't provide advice. The SAS trustee doesn't provide financial advice. The only person who can provide advice is a regulated financial advisor who specializes in pension transfers. So to move it from one investment pot to another on the risk mandate doesn't sound that different. But where the difference is about you coming out of an FCA regulated product into a product that's regulated by HMRC and the pensions regulator, and you making mistakes, you will lose the money.
Or possibly get fined as well.
Yeah, and you won't get it, you won't have any protection, you won't be able to get it back because the SAS scheme is not regulated by the FCA.
It's a bit like a home mortgage, which is regulated by the FCA, and buy-to-lets, which are not. So an analogy of that, not quite the same. Is that right?
Yeah, I can see where you're going with that, deal. Yeah.
Okay. So as I understand it, sorry, as I understand it, the journey would start with a pension savvy IFA for advice, and then follow up from there.
Well, no, because when I speak to people and they get their head around it and they think, right, okay, I've got 260,000. Let's use your viewers' question. I've got 260,000 in a pension fund. I'm doing these property developments. I could really use some of that money to invest in these property developments. It's going to be my equity. It's going to be a really good move for me to do that. And I can make twice as much money as the pension fund's done. So when it comes back to it, that person has to decide, do I need financial advice to make that decision, or do I know what I'm doing with the property development? And you can't get away from that. At the end of the day, it's highly recommended that you have financial advice. So like people go and get a capital repayment mortgage. It's highly recommended you get financial advice to get a capital repayment mortgage. Any type of advice these days, any type of financial decision, people always say you should have financial advice. Whether you need it or not is up to you. It really depends on your skill set and how comfortable you are with the risks and investment decisions you're going to make.
Okay, so the point I'm trying to get at is that, say a person like our person here has £260,000 in the pension fund, and he's, I presume, a property person and property savvy.
Yeah.
Where does the journey begin?
So the journey begins with him contacting a SAS trustee to confirm that his pension fund is transferable across into the SAS scheme. He needs to talk through the scheme with the SAS trustee to make sure that they're happy with what he wants to do as well. Because remember, they can't invest in residential property. So we need to understand exactly what that person is trying to achieve on the property journey with this. And then if the SAS trustee agrees with that, you just open it up and you get going. And it's as simple as that. But along the way, someone, well, the viewer, needs to decide on the 260, am I happy to make my own investment decisions? And if you say yes, and you tell the SAS trustee you're happy to make your own investment decisions, you don't need financial advice. If it's in one of these complicated final salary schemes, whereby you're getting a fixed return, then you have to have financial advice. You can't get away from it. But if it's in a straightforward stock market investment, you're literally switching the asset class from the stock market to property. So
that clears quite a few things. Yep. So
that in itself is how it works. I sit in the middle. I guide people along the way on a consultancy basis, send them off to the right type of SAS trustee that will match up with their requirements. And we charge £500 to do that, because we'll sit with you for a few hours, fill out a KYC, see where you are, where you're at, find you the right SAS trustee, put you in touch, get it set up, and then you pay us when it's done.
Well, that's exactly what I was trying to get at, Simon, to see where you fit in. Now, you said that provided they come to you, you can guide them.
Yeah.
Not provide financial advice, but guide them to where they can get such guidance and advice.
Where this sets up and where this is different is the SAS product is not regulated by the FCA. So I no longer practice. So this is where I sit now in the middle. So we can establish with your pension fund whether we think it's a good idea. We'll talk you through it, find out what you're up to, see if the property journey works, what we think will work, guide you to a SAS trustee that will welcome you with open arms, that type of deal. And when it's done and dusted,
basically Simon, basically you guide and shortcut them through the process and find the right person for dealing with each of the issues.
Yeah. If they want us to actually set up the SAS, because last count there's about 19 signatures needed across about 30 forms, then we do that as well, and we stay with you throughout the whole journey from start to finish. But that's a time-consuming process, and we fill out all the forms for you and just put the post-it notes and where you need to sign, then we charge £2,000 for that journey as well.
Yeah.
Simon, there's another question in the chat.
Yeah.
Does government top up any of your contributions to the SAS
Right.
as they would with a standard company or stakeholder
Right.
pension?
So the SAS pension wrapper, so if we just look at it, we've got personal pensions, we've got self-invested personal pensions, and we've got a SAS pension. The word pension is included in all of those titles. So the rules on tax relief, pension retirement ages, pension drawdown, tax-free cash, nothing changes. All of these rules for your pension funds stay exactly the same, whether it's new contributions, old contributions, money going in, money coming out, all the rules stay the same. So if you've got a SAS, you put more money in there, you'll get tax relief. If it's in a personal pension, the same rules. When you come to take the money out, it's the same rules. What this does with the SAS wrapper now is it gives you access to play with your pension money, but until you reach age 55, after you've finished on your property investment, it goes back into the pension and then you borrow it back out again. It's not yours to keep. That's why if you look back at what we've discussed today, with a lot of the rules and regulations in place, they are loans. And that loan means it's going back to the pension fund. And that's how you're getting it out, because it's a loan. And because it's a loan, it's key that you repay it.
Right, that brings me to the final point. As you said, it's a loan.
Yeah.
And
Last
needs
50 beats, Rinda, for you.
and needs security. Does it have to be first charge, or can it be second or third or whatever?
So when you do a loan to another developer on an unconnected basis, you don't even need security. It can just be a loan if you want it to be, a loan agreement. It's only when you're lending the money back to your own limited company, like our viewer that's using the viewer's question and his fund. So he had 260. If he wanted to lend back 130 back to his company to go on a business expansion journey and using his pension funds to do that, that's where you would need a first legal charge.
Okay.
So
Happy, Rinda?
Yeah, you don't need any but for your comfort, if you lend it to somebody, you would need some sort of security anyway.
absolutely. I mean, I lend money on a first, second, personal guarantee, debenture, whatever someone's got on the table, there's a deal there to be done, and a risk and an interest rate to match with it.
Right.
Simon.
So if it's a debenture, what sort of interest rate or ballpark figure would it be?
Well, it depends on how strong the company is, really, Surinder. I mean, SAS lending starts at about 8% and goes all the way up to 20%, and somewhere in the middle, depends on how strong the deal is.
Sure.
Because, why do people do it? If you go to a development bank and you've got a first legal charge, you can probably, if you're an A1 developer, you get it at 6. But the developer bank asks an awful lot of questions, whereas the SAS lender might be a little bit more generous. And if you're a little bit more generous, then they'll pay a little bit higher interest rate.
Sure.
Simon.
Okay.
Surinder, sorry.
I'm done.
More 50p's?
You have to do it if you want any more.
Okay.
Ask any more questions.
Yeah, I've got a question for you, Simon.
Okay.
So, let's take the scenario comparing a pension with a property scenario.
Yeah.
That's right. So with a pension, normally when you've got a defined benefit pension, the original pension holder gets his money every year, and when they die, the spouse usually gets 50%.
Correct.
And when the spouse leaves this mortal coil, the kids get nothing. Yeah.
Correct. Yes.
Now compare that with a SIP or SAS, whichever.
Yeah.
They take that money and they put it into a SIP or a SAS.
Yeah.
the money from the property goes to the original pension holder.
Yeah.
When they leave us, all of that money will then go to their spouse.
Yep.
And when the spouse departs, all of that money will then go to their children or whoever they want it to go to. Is that correct?
Yes.
So that's the main benefit of.
That's another benefit. This is separate. You're into the worlds of final salary pension, discussing then the benefits,
Yeah.
And advantages or disadvantages of whether or not to transfer away from having a fixed pension for life or a massive lump sum. Now, there are some absolutely spectacular lump sums out there available being offered because of the sheer cost of running these schemes. So I could reel off 4 companies to you, like BP, British Airways, Asda, Barclays Bank, who don't want these pensioners on their books forever. So they're willing to pay off phenomenal sums of money.
So am I right? Am I right in my understanding that the lower the interest rates, the bigger your pot's going to be? Is that a good analogy?
Yes, it is. It's an unusual analogy to for people to get their head round, but it basically works that way because what actually happens is, say if we take Barclays in that equation, Barclays as a pension holder has to work out what your £20,000 a year pension is going to cost them for life and what money they need to keep in their pension reserve, their billions of pounds, to continually pay that to you. And that's based on a 15-year gilt rate. So if interest rates are really low, then obviously they've got to have hundreds of thousands of pounds in that fund for you to give you an annual payment of 20,000 a year. If interest rates rocket upwards to 5–10%, they wouldn't need to keep so much money in their fund. But you're perfectly right in your analogy before that, and why it's popular as well. Someone gets offered £7,000 a year, making these numbers up, but as an incentive to move away, they're being offered £200,000–300,000 as a lump sum. And people look at it and they think, wow, that doesn't make any sense, you know. But what happens if you live to 95? That will index link the 7, it will keep growing up. But what happens if you die the following year when someone said to you, here's 300,000 up front now? You're quite right. That 300 goes to your wife and children. That's a separate conversation they really deal with regards to pensions, because it's about getting tax advice, pension advice on if that's the right journey for you to go. It's very difficult to move funds away from final salary into your own pension fund. There's a lot of hoops to jump through to get there, and it takes about 6 months, but it's very worth investigating the numbers.
And what's the age parameters? What age can you start and what age is it too late? Is there an age?
They just recently changed the laws on this. So you've got to be age 50 now to actually consider transferring the pension away.
Okay.
From your existing provider.
Okay.
If you're below that age, there might be some, you know, bizarre rules and conditions around, but let's just go with that for now. That you've got to be 50 to actually transfer it away, because there's less. The FCA are really clamping down on pension transfers. They don't trust the British public to have these big lump sums of money and manage it themselves to fund their entire retirement. I mean, it's just how it is.
Yeah, the reason I'm laughing, it's even worse in the States. That to be an accredited investor is even harder in the States.
Yeah.
And I listened to a YouTuber who's phenomenally wealthy, and he goes, I might be wealthy, but I haven't got a clue in financial investments. And he's really funny in terms of how he phrases it, but that's a good point. Simon, earlier you said you can use your parents as security. Did you mean your parents or the assets that your parents?
Oh, did I? Thank you for the correction.
Yeah, I knew.
Oh, I don't know, actually. I haven't actually approached a SaaS company and actually asked them if I could use my parents as security. They probably prefer the house, though, I think, now.
So will you do that and come back next time and tell us if you can use your parents as security?
Yeah, or maybe we just correct that to your parents' property as an example.
No, I like your parents better. I think
it's a great one as well. Deposit them in.
Yeah, exactly. And
speed up the inheritance.
Well, the HMRC will have to look after them then.
Precisely. You see, this is a win-win for everybody.
Yeah, magic. Simon, is there anybody that you think would be useful for us to bring on in this affair of understanding for our viewers?
How do you mean, Dill?
Someone that you think would be useful to do a program with and drill into this a bit more in depth.
Someone who will complement you.
Yeah, that's it.
Indeed.
That's the big word I was looking for.
Yeah, I mean, in terms of the SaaS world, there aren't that many of us out there. There was a guy I was talking to during the wonders of COVID. His name was Neil Ryder, and he's a real SaaS guru. I know a lot about SaaS, but SaaS is a huge book and Bible to read through with loads of grey matter in there, which is subject to opinion. But I spoke with Neil last year, and he was very impressive on his knowledge. If your viewers want to drill down that deep into, the SaaS rules and regulations, sometimes it's a bit mind-blowing. Talking about pensions for 45 minutes. The exciting bit about SaaS pensions is what you can do with it, investing into it. And halfway through the journey, you find out it might be even better because you can do something else with it. But the main nutshells around what I've done today, covering the sort of benefits of what a SaaS pension plan can do for you. If viewers want to drill down into it, then that's a guy that you should probably speak to.
I think can we ask you to organise that for us, you and Surinder?
Yeah.
So, I get excited when I think about the number of 50p these pension pots contain. I think it's magic. But Simon, look, thank you for your time. It's been super interesting, really worth looking into. Come back when, I'm guessing when we're a bit more into the summer and when you can get hold of Mr. Ryder and Surinder, I'll get you to organise something with him if you wouldn't mind.
But how often is the social meets? We should have a chat about that. Is that going to be a quarterly event?
Simon, it's not a social meet. It's a business meeting.
All right, the face-to-face TPP business meeting.
That's it. Araful Killer.
On 24th of February at 6 p.m. I was listening at the Laguna restaurant in Ealing, and there is how many tickets left? 4?
Sorry?
There's only 4 tickets left, is there?
There's only 4 tickets left for that, yeah.
Yes. So, yeah.
Because we have limited space there.
Yeah.
We
will consider. Would it be? Is it going to be a quarterly event? Do you think?
Well, we hope we can do it more often than that, but quarterly would be of our first
starting point.
Yeah.
Oh, all right.
Depends what Mr. Coronavirus says, doesn't it? Really.
I think Mr. Coronavirus has no say anymore, according to the government.
Yeah.
Deal, come on. As for the 28th of February, coronavirus does no longer exist.
Yes, right, sure.
According to the government, anyway.
It's evaporated.
Yeah, it's gone.
We're going into a different show. We might get banned in the American territories for that. But look, Simon, thank you. It's a pleasure as always.
Yeah.
And fantastic.
If any of the viewers got any questions, you can reach out to me. I'll happily reply back.
Great.
Thank you. Thanks very much.
Anyway,
thank you for having me.
Thank you for inviting me.
No show next week, in-person live event. Actually, you might do
we are thinking of trying to get the logistics working if we can broadcast, but it will be at a later time. We don't start till 6 o'clock. So we'll just do a Facebook Live on it.
Okay, Facebook Live. Well, you could do a YouTube Live as well, actually, I think.
Well, see who's there.
Yeah. Unfortunately, I can't make it because I'll still be in isolation.
Good luck.
Right. We'll see everybody. You'll see